Things for real. First of all is you'll notice on the document there is the notice of recording. So the session today is being recorded, just to make sure you're aware of that. The second thing is to advise you that there's no planned fire drill today. If you hear the alarm, please treat it as real and evacuate the building in the nearest safe escape route following me. The escape route is via the stairs as you leave the council chamber or the public gallery, which is empty, via the door at the back of the building, walk across the inner car park to the evacuation point where we all gathered the other day at 12 o'clock to make sure that we're all safe and sound. Do not use the lifts and do not re-enter the building until you're advised it is safe to do so. And can I remind you, please, if you have mobile phones, to make sure they're turned off or on silent. For the rest of the meeting. Right, I think that's all the notices I need to get out of the way. I'm not going to put the gavel down for each individual item. Don't want to shock you too much. First item then is the to confirm the minutes of the last meeting held on the 28th of July. You've all been circulated with a copy of those minutes. Were there any comments or issues on them? All right, Claire's proposing them. Do I have a seconder? I've got a very shallow pond here to select from today. So, yeah, right. All in favour? Right, carried unanimously. Thank you very much indeed. I'll sign those. Good. Thank you. Next item on the agenda 2 is the declarations of interest to invite members if they have any items on the agenda today that they would like to disclose an interest in. Richard.
Not a declaration, it's just I will need to leave at 11:20 due to a medical appointment, so my apologies.
We were forewarned of that, so we understand completely. Right, no other declarations of interest. Number 3 is the public question time. I understand we have no public questions, there's nobody in the gallery, so thank you very much. We'll dismiss with that one.
Because I might miss members' question time, could I raise something now? It's a point really in support of Joe, is that in the press a couple of weeks ago we had the hit on investments in fossil fuels and the like. I do remember very clearly that it was a question that we asked of the fund managers at the time and they couldn't give us an answer. So I was a bit disappointed that you weren't able to get the information, despite how much you tried, yet the press had that information within half an hour. So it's just really a point of clarification why we didn't know.
Good point, though.
Thank you. Thanks, Richard. We would have been able to have the information, but we don't hold any direct holdings ourselves, so we would have had to go to the fund managers to ask for that information. The request came through at 2:30 for a 6 o'clock deadline, which is totally inappropriate in the best of times anyway. We then sought the information and explained to the press that we would have to do that. They decided they would publish anyway. I have drafted a response and it is with the Chief Exec for his onward submission. So thank you.
I think from my point of view, it was that we clearly asked at the time and we were sort of fobbed off because I remember I pointed out, I asked for Glencore Holdings, which was one that came up, and fossil fuels, and we just said, oh, it's not very much, don't worry about it. It was a response. And I don't think that was fair on you, is basically what I'm saying, because you're the one that ends up carrying the can.
The answer is that it's about £26 million, which is about 3.2% of the total fund.
All right, thank you for that. So item 4 on the agenda is the report, which has already been presented to full council, of the local pension board. Joe, I think several of us have seen this quite a few times now. You
have seen this quite a few times. So what I wanted to do was give you a bit of an update on where we are in terms of the recruitment for the board. So
particularly items 9 and 10, I think, weren't they?
Bear with me just a second. Yes, so the recruitment activity that we've undertaken, we've had 2 appointments confirmed by full council, as you're aware, and both of the members are here today in an observer category. We sent out the admin team for the remaining 2 scheme member representatives. The administration team held emails for members on their administration database. We sent out 10,087 emails to the various members, active, deferred and pensioner. And of those 10,000 emails, we had 5 expressions of interest. So the 5 expressions of interest were sent to Councillor Jarman as Chair of the Pension Fund Committee and Chris Ward as Section 151 Officer on the 15th of November for their review and consideration of how we complete the recruitment, and the appointment for that will be confirmed at January's full council meeting. For the external employer reps, so the other employers within the fund that's not the council, we sent out 30 emails, which is to each of the employers, and I had no expressions of interest from them at all. So I'm having to recirculate and seek more information from them. And for the third employer rep, which is an officer of the council, a report went to the corporate management team on the 16th of November, seeking nominations for that representative post, which will be finalised at corporate management team on 7th of December. And will be appointed, confirmed at full council in January. Lastly, the independent chairperson. I approached 2 people who had previously approached me to see whether we had an independent chair, and put on the Local Government Association LGPS mailing list. We've had 4 applicants for the independent chair post. All high quality, and again those were sent to Councillor Jarman and Chris Ward on the 15th of November even, apologies. All of the appointments will be confirmed at the January full council meeting. Because the board remains not fully populated in terms of membership, we've cancelled the 15th of December scheduled board meeting, and it's been postponed until the 2nd of February, when all of the members should be in post. So it's really just to update members on the process that's been followed and the progress that's being made.
Excellent, thank you, Joe. Any questions to Joe on that item? Quite a disappointing reply though, wasn't it?
I was quite surprised to get 5.
Okay, it's good that you can laugh at a pension meeting.
We've taken the view to, we cancelled the September meeting. We have postponed the December meeting to February, and we will have the March meeting. So we'll have 3 out of the 4 that we're supposed to have, but we scheduled 4, and for unforeseen circumstances due to vacancies, one of them was cancelled. That's acceptable. We've attempted to hold them.
Thank you. So we've got a couple of appendices to this, 1 and 2, which are the revised terms of reference for the board, and the appointments for the board, subject to what Joe has just updated us on. Are there any questions on those, or if not, I'll move that we accept the recommendation, which is on page 15 of the document today. Do I have a seconder for that? Yes, thank you, Claire. Everybody in favour? That's carried unanimously. Thank you very much indeed. Right, moving on to item 5 on the agenda, which is the reports from the local pension board itself, starting on page 37. Joe.
Really, members, this is just for noting both of these items. The pension board meeting that was held on the 21st of July, all of the issues many of the issues that were considered in that meeting will be addressed by the recruitment of the new board. So really just members for information that this was the matters that were discussed. And then on page 35 of your pack, you've got the annual report of the local pension board. This was presented in draft to the committee at its last meeting, but now this is the finalised version, which was agreed by the former chair of the pension board before her term of office expired. So members, really, this report will be published as part of the pension funds annual report and accounts, which we'll come on to shortly. So really it's for members to agree and adopt this report for publication in the annual report and on the pension funds website.
Good. Any queries on that? Are we happy to proceed as Joe suggested? Everybody in favour? I think it's unanimous again. So all well and good, Joe.
Thank you.
Right. Moving on to item 6 on the agenda, which I think is where we start to get into the meat of things, which is the response for the external auditors. I had a couple of questions on this myself, actually. One was, is there an update to the outstanding issues which are on page 46? What did I put page 46 in? Yeah. They noted at the time that they were substantially complete and there were a number of outstanding items. Do we have an update on any of those?
Thank you. At the audit committee itself, I believe the auditors confirmed that the work was complete, subject to the update of subsequent events, the receipt of the management letter of representation, and the consistency of the accounts in the report. Everything else has been completed, and we are just waiting for the accounts of the council to be approved, which contain the accounts of the pension fund, before we can finalise absolutely the external audit for the pension fund accounts.
Yeah. Well, I think it was a very good outcome, and I think we owe a great debt of thanks to you, Joe, Joe here, and for seeing us. I don't know how to distinguish between the two, actually. Joe C. Joe. For managing us through and providing all the financial information and making sure that everything came out with a very clean bill of health. There was on the wider council originally a date when I spoke to the external auditors that we might get the documentation through some date in late November, with the possibility of maybe bringing forward a meeting. That wasn't possible, of the wider audit committee. I note now that the external auditors are looking to conclude and submit on the 6th of December. Is the 6th of December not also the day of the audit committee? So they're giving their final report from the auditors on the same day the committee meets. Ooh.
It will be published in line with the committee reporting papers. So it will be published a week before, on Friday this week. So members will have the opportunity to see it. But generally, the accounts for the council are finalised on the day of the audit committee meeting, and they're signed by the audit committee chair at that point.
Sorry, on a slightly different point, but page 45, it's really, because I really do like asking daft questions. What exactly does that mean? Planning materiality and performance materiality, because they're quite big numbers, so I just wondered what that was.
That is a technicality of the audit world, which basically suggests that they look at transactions in that quantum, and if things are bigger than that, then they are considered material and important, so that they will do further work on them. And if they're below those numbers, then they are less material. They won't make a big difference to the accounts. If they're wrong, they will make a difference, and they will report items that are within those numbers to the audit committee or the pension fund committee. So the reason that they're such a big size is they're primarily based on a percentage of the assets that the fund holds. So as at the year end, I think the assets were around £650 million. So a small percentage of that is quite a large number. So
effectively, any figure, so for planning materiality, a number lower than that, they don't look at it. Is that what you mean? Or they're only checking numbers bigger than that? I'm a bit lost, sorry. It's me being daft.
No, they will look at those numbers, but they will base their sample size on the population, effectively the population divided by that number. So the value divided by that number will calculate their sample size to an extent. And so they'll use that to test transactions and to test activities. And then if there is something significantly different as a result of that, then they will report it as an issue. And then in terms of the audit differences, that's primarily on the revenue account, so on the income and expenditure, which is a much smaller quantum, so the materiality level is much smaller. So they'll report unadjusted or the differences of a smaller number. And but you'll note that there were no matters that were needed to be drawn to members' attention at that point.
Yes, so in each case, the final was bigger than the planned and there were no matters. So that's the key thing. Hello, Vanessa and Warren.
Sorry, apologies. I'm afraid Island Road completely blocked my little estate off. I couldn't do anything about it. I do apologise.
So, well, we see my phone was late. So.
Right. So on 6A specifically then, are there any other questions? No? Good. I'm not too sure if we need to do anything more at this stage on them, do we, Joe?
No, the committee, just to note at the moment, the audit findings from the external audit of the accounts.
Yeah. There's nothing more we can do with them. They just go forward and get part of the conglomeration for the 6th of December. As
the accounts themselves, yes, form part of the council's accounts, not separate. But the pension fund has a duty to prepare, a statutory duty to prepare and publish an annual report which contains the accounts.
Good.
Which is the next item on the agenda.
Okay, are we content to so note them? Good. And I suppose the same material consideration comes with 6B then, which is the actual report and accounts themselves, Joe.
Yes, so the annual report and accounts are required by statute to be published by the 1st of December of each year. Obviously, as a result of the late completion of the council's audit, we will not be in compliance with that deadline this year, we have reported that to the Local Government Association, and we've also reported it on the pension fund's breach log, but we've not deemed it significantly material to report to the pensions regulator. We are not the only pension fund that is not going to meet this deadline this year, which is not an excuse. It's not a good thing, but it's kind of a little bit endemic of the whole situation of the external audit around the country.
And it's arisen largely because of the changes to the conditions of external auditing rather than any default on our side. Important to point that out.
And from the pension fund committee's perspective, it is a result of issues with the council's audit rather than the audit of the pension fund. Yes. So item 6B on your agenda on page 77 summarises the content of the annual report, page 78 in particular, and lists all of the items that are presented. Those in italics on page 78 are presented as the appendix to this report. Those are published online already or have previously been seen by the council are hyperlinks have been provided in that table that you can look at. And the two bits that are already considered on this agenda, you've got the annual report of the pension board, which you've just adopted, and the risk policy, which you're just about to adopt on a subsequent item. Those are presented today, and the two remaining parts, the statement of responsibilities for the statement of accounts and the independent auditor's statement, are not included because those won't be ready until the accounts are finalised for the council. So basically, the content of the annual report is prescribed by best practice guidance. Members will have the opportunity as part of the appendix to see all of the documents that haven't previously been presented to this committee. And the recommendation for this report, the recommendations are on page 81, that the pension fund's annual report and accounts for the year ended 31st of March 2021 be approved, subject to external audit, that the annual report and accounts be published on the pension fund's website as soon as possible following the completion of the council's external audit, and that the committee be notified when the annual report is published. There's a lot of documentation. It's a big appendix. I'm very sorry for that, but the full document is about 150, 160 pages long. When it's published, I will expect you all to read it and we will ask questions. But happy to take any questions on the information or the publication, but otherwise would move the recommendations.
I think the only thing I noted was paragraph 16 in there. That's why I took the with the external auditors. So they're actually issuing their it's a draft report then this Friday. Is that right, Megan? Yeah. So the draft report comes out on Friday, and the final report, once approved, after the 6th of December audit committee will come out. All right, I've got it now. Any questions of Joe? Right, can I propose then that we accept the recommendations on page 81, number 27, 28 and 29? Do we have a seconder for that? Vanessa? Thank you. Everybody happy with that? Jolly good, unanimous. Thank you very much and well done, Joe. Again. Right, Joe. Let's have a look. We're going to jump through quite a number of pages now to item 7 on the agenda, which is page 117, people. Right, Joe.
There are a couple of items on this agenda that aren't Joe to lead, you'll be pleased to know,
yes,
but at the moment it's all me. So this is asking the committee to formally adopt the decision-making matrix that was subject to the development session that was held on the 7th of September. Completion and acceptance of a decision-making matrix supports compliance with the Scheme Advisory Board's Good Governance Project recommendation concerning the documentation of various roles and responsibilities in relation to decisions that are made in respect of the pension fund. The matrix itself is presented as the appendix to this report. It was circulated to all committee and board members following the development session, and no comments were received in terms of that. The electronic copy is in colour. The black and white copy may be difficult to read in black and white, for which I apologise. But if members do want a colour copy printed, I'm very happy to provide that. The bulk of the decisions are approved by Pension Fund Committee and with input from the Pension Board, Section 151 officer, other officers and advisors to the fund. We have had confirmation that the Cabinet member for Resources and Technical Finance, Resources, Strategic Finance and Transformational Change, is that right?
It'll do.
Thank you, sorry. Does not have any specific responsibility for the pension fund, as under regulations, the running of the pension fund is not an executive function. So Councillor Jarman, in his role as Cabinet member, does not have a responsibility, but in his role as Chairman of the Pension Fund Committee, he will lead you through your decision-making process and support the approvals. So effectively, the recommendation is on page 121 at paragraph 32 and 33, that the decision-making matrix as presented at Appendix 1 be adopted, and that all future decisions in respect of the fund be considered in line with the responsibilities contained therein. I'm happy to take any questions or comments that members may have.
I think a lot of work's gone into this. I'm very happy and thank you. I know there was an exchange of emails clarifying roles and things, which was very much appreciated. Are there any questions on the decision matrix which we've worked on? Vanessa?
Yes, it's not so much a question as a statement that this clearly defines the role of the pension board, because we have had tensions in the past few years over the role that the board plays. And I feel this sets out quite clearly, categorically, this is how it works. And it's quite simple to understand. Thank you, Joe, for that. So I personally would recommend this. Thank you.
I'll take that as a motion to adopt.
Yes, a proposal, Chair.
Do we have a second?
Chairman, sorry, Councillor Lilly has a
question. Sorry, Michael, I was looking in the wrong direction.
As the Isle of Wight Council's representative, obviously the board is not fully operational as their membership. Wouldn't it be good, once it is in place, for that board to have a meeting with this committee, taking on board what Vanessa has just said, right? So that right from the onset of the new board, because it will be practically an entirely new board, can actually get synergy with this matrix, right? So there isn't future tension between this committee and the board. That makes sense.
Thank you.
My recommendation as a result of that is that once the independent chairperson of the board has been appointed, we will be setting up regular meetings between the independent chair of the board and the chairman of the pension fund committee to consolidate that. But board members are very much welcome to attend development sessions that are presented to the pension fund committee, where we can discuss decisions and decision-making matrices. We absolutely will consider pulling a joint meeting together or a development session or something, so that all members of the board can meet with all members of the committee or those that wish to attend, so that the decision-making matrix can be reviewed. But the process and the terms of reference for the board and the role profile for the board members has been created in such a way that it reflects the decision-making matrix and the roles and responsibilities of the board. And we will be discussing those at board meetings to ensure that all members are happy with what's going on. But I will make a note of a request for a meeting with the board and the committee, and we'll try and factor that into the work plan.
I just take on what Melissa was just saying, and I just feel that we should do everything possible.
Yeah, I think there are clearly a number of, I think it's a good idea. I think there are a number of steps to get there. Having the board in place is clearly one thing. Making sure they've gone through the training and everything and they're up to speed with what the matters we'd be discussing would be another one. But I think, you know, we will get to that point, Michael. Thank you.
I did attend that session where that specification was discussed.
Can you put your microphone on, Trevor, please? Sorry.
I did attend the development session where that matrix was discussed.
Right. Good. Not sure where we got to there. Did we actually, we need to formally adopt the recommendations at the items 32 and 33 then. I think we got to, Vanessa was saying yes, and then somebody else was going to propose, but we missed the question from Michael. Do we have a seconder for Vanessa? Yep. So Warren, everybody happy with that to adopt them? Thank you, everyone. Right. Next one is to go on to section 8 on page 125, which is the risk register.
A slight misnomer on the agenda, for which apologies. It's not the risk register itself, this is a risk management policy that we're adopting today. The risk management policy was scheduled for review, was formally adopted in 2019, was scheduled for annual review in 2020, but COVID. So this is the annual review slightly delayed. But following the workshop that was held on the 6th of October in terms of risk management and the process for the pension fund. The full revised risk management policy is presented at Appendix 1 to this report, and a summary of changes from the previous version is summarised at Appendix 2. The following adoption of the risk management policy, the risk register is being developed and will be presented at all future committee and board meetings for review and maintenance, with an annual meeting to consider the risk register in full going forward, and a review of the policy which will be built into the work plan. So the risk register itself will be presented to the February pension board meeting and the February pension committee meeting for adoption and consideration. But at this point, we're asking for adoption of the risk management policy, that changes to the risk management policy be approved for publication on the pension fund's website and for inclusion in the fund's annual report and accounts. very happy to take any questions at this stage.
Are there any questions for Joe on the slightly updated version of our risk management policy? Would somebody, sorry? It is really. Would somebody like to move that formally? Claire, thank you. Somebody to second? Ian, thank you. Everybody in favour of that? Right, carried unanimously again. Thank you. On to item 9 on the agenda on page 143. The valuation of the fund's investments as of the end of September this year. A very nice position to see ourselves in, I think, and with some relief, Joe. Thank you.
Yes, very positive. If we can combine this whole item, and basically I'll hand over to Emma from Hyman's, who is on the screen, to take us through the valuation and the investment report and the funding levels. Thanks, Emma.
No problem. Can you hear and see me okay?
Yes, thank you.
Okay, so I'll start off with a brief market background. In terms of general economic growth, we've experienced really strong growth as the world began to reopen following the pandemic lockdowns. That was evident from the really strong equity rallies we've seen. You'll see that returns over the past 12 months for global equities as a whole are nearly 22%, and this is reflective of the economy starting back up post the pandemic. The pace of growth over the quarter to end September did slow, but the expectations for global growth over the rest of this year and next year do remain strong. So we'll expect to see those equity returns stay in the positive for the short term. Performance was mixed across both region and sectors. So energy prices rose substantially over this period, and that benefited lots of energy and utility sectors within markets. So you'll see that the returns for those sectors were strong. But high inflation was coupled with that. So high inflation expectations, expected rise to interest rates to compensate for those inflation expectations means that services in the financial sector detracted. So whilst it was positive for the period as a whole, there were winners and losers within sectors and regions for that. Both the UK and Japan outperformed. Japan is finally benefiting from declining COVID rates, and the UK's large overweight to energy. The UK have a big allocation to the oil and gas sector based on the type of economy that we have, and so that hike in energy prices really boosted those stocks within the UK, which is why they outperformed the global market. Emerging markets underperformed. There's a lot of tightening of restrictions going on in China just now, and that's dampening down on manufacturing expectations and growth within China. So that dragged down the emerging markets element of the market. UK property as a whole continues to perform well. So capital values are still rising, rents are coming back, and defaults are reducing. So UK property has seen a 7.5% increase in capital value over that quarter too. Corporate bonds were little unchanged, and the return that you're getting on gilts, so government bonds, did improve over the period, which is a positive from your funding perspective because that reduces the value of your liabilities. And as the chair said, the valuation is looking quite healthy for the fund. It did increase over the period from 726 million to 731.9 million, so continually gradually increasing. What I would like to point out from the valuation of the fund is your significant overweight position to growth assets. So as part of your strategy review, you have agreed to trim back some of those positions in favour of income assets. Basically, walking away from the table while you're winning, crystallising those market gains that you've experienced and putting them into something else to help diversify the returns that you're getting for the fund, reduce the level of risk you're running in the portfolio, because currently about 70% of your portfolio are invested in equities, so stocks and shares and high growth, which can be very volatile. It's worked very much in your favour while markets are rallying, but could also turn if markets were to decline. So we want to see those positions trimmed back, and Joe and I are working in the background to facilitate your new mandate that you agreed to invest in, the UBS Climate Aware Equity Fund as well. And when we do that, we're going to trim back some of those positions and hold a little bit in cash pending the drawdown of your new 2 mandates with Partners and Goldman Sachs. Just as a reminder, you've got 2 new mandates appearing in your valuation table now. You've got your Goldman Sachs private debt mandate, so that's lending to companies that are outside of listed markets. And then you've also got your infrastructure mandate. Now, it will take a while for those allocations to build up. They're in private markets, so you'll only pay money to those managers when they identify investable opportunities. They will go out and they will look for opportunities, and then when they find a good one, they will ask you for the money. So there'll be regular capital calls, and Joe's been doing a fantastic job at managing all of them. They've been coming thick and fast for the Goldman Sachs mandate, and you have quite a short turnaround to get the money to them. So kudos to Joe for that one. You will see that allocation start to ramp up. So just to flag that overweight, we are addressing it in the background. It will come down in time as those 2 new mandates are built up. It just takes a little while to get there. Then performance of the fund again has been really positive. You're ahead of benchmark. All your mandates returned either in line or ahead of their benchmark over the period. Over the long term, the fund itself is ahead of its benchmark target. So it was 1.4 versus 1 over the period to end September. But over the last 12 months and 3 years, and even the long term over 5 years, the fund has performed ahead of its performance target. What that means overall is that you're a really healthy funding position as well. You're about 101% funded on a TP basis, which means that you're pretty much in that corridor of steady state, what's coming in equals coming out, and it's all about managing that risk and staying within that full fund window as you continue to monitor the group. The other thing I'd want to point out, I'm not going to turn the pages on the later parts of the report. You do have new pages there for your 2 new mandates. They will start to populate with more information as the mandates get invested and there's more information available from those investments. But the one thing I did want to point out is the downgrade to Moyes. So Moyes are your UK equity investment manager, and they manage a active equity portfolio for you. So that means that they are trying to actively beat the benchmark that they are targeting, and they invest mainly within UK securities. And the reason we've downgraded for that is a few reasons. Mainly because of the high turnover we've seen at the manager in terms of portfolio managers. In the last 2 years, they've had 3 big names leave the strategy, and that always causes a bit of disruption. Who's going to come in and make the decisions in place of those people that left? And although the reasons for those decisions are things like retirements, it does still provide some disruption to the management of that mandate. Also, historically, that Moyes mandate has focused on what we call a value style of investment. So identifying stocks that look cheap in the market and then investing in them, hoping that they will outperform. And they've had that style for a very long time. And that's what we rated that mandate as preferred from originally. And since we've had quite a lot of turnover within the mandate, they've had new portfolio managers brought in, and the style of that mandate is changing over time. There's been quite a lot of churn within the mandate, and it's less of a value focused and much more focused on growth. Now, that's not necessarily a bad thing. It's just that the previous rating was based on a mandate that has a very different style to the one that we have now. So we're still rating it as suitable in that we have no concerns. We are not advising that you disinvest from this mandate. It's just that we can no longer rate it as one of our preferred strategies because the strategy has changed so much in the last couple of years. So I'd recommend having Moyes along to the next meeting. The assets under management for that overall strategy, so the amount of money that's invested in that, you are just one of many investors, has declined over the last few years as well. So that gives us some modest concerns to do with the scalability of the size of the mandate as well. They struggled after Brexit, so really we just want to keep it on watch. The changes could be positive, but they could equally not be. And so whilst we are in this transition period, we need to monitor it more closely before we can provide comfort of rating it as something like preferred. So for just now, it's a suitable mandate, and it furthers our previous advice to take some money away from your active managers. Both Newton and Moyes, your active equity managers, have been downgraded in the last year or so, and this is because of manager changes and changes to the portfolio. You're exposed to quite a high level of active manager risk, so having a passive mandate like you've agreed to go into with UBS reduces some of that concentration risk, reduces some of that reliance on key persons at managers, and helps to spread the style of your equity investing. So it just furthers the decisions that you've already made as a committee to reduce your allocation to equities as a whole, reduce your allocation to the UK, reduce your allocation to active management in favour of a passive approach. So there has been significant change. We're keeping it under close review, and we'll keep you updated if our opinion on that changes. But for now, It's still rated suitable. We still do have a lot of things about Majedi that we do like, particularly how much of the company is self-owned by the partners of the fund. They all have skin in the game. It's all within their best interest that their funds perform well. But until we see a longer period of how this new strategy and new management style is playing out, then we want to just leave it as suitable for now and keep an eye on it. Other than that, I wasn't going to cover the performance of the mandates in any more detail unless anyone in the committee has any questions.
Yeah, thank you. Again, a lot of work. Page 151, this is really on the back of our council declaring they're going to divest from fossil fuels. Is the difference between the Hyman's rating and the responsible investment rating? There's a reasonable conflict, I'd say, between the two. Now, it's not really a question because I know we can't really do a lot about it, but I think it's just to highlight for the committee is that we've got Hyman's ratings of the worst suitable to preferred and responsible investment at best good. So there's obviously a conflict there in terms of the returns based on how that's measured in terms of responsible investment.
Yes, so is it just a comment as opposed to a question?
Yeah, just a comment, yeah.
Okay, so we rate them both separately. So there's lots of things that feed into our overall manager rating, not just the responsible investment element. So there can be managers that have very good responsible investment practices. That doesn't necessarily feed into every element of what makes a good investment and vice versa.
Thank you. Vanessa.
I just wanted to check, Emma, did you say our fund had gone up by 500k from whatever it was up? You make it sound like £500. 500k is a lot of money. Can you confirm that, please?
So your fund value is actually increased by 5.5 million over the quarter.
No, the other question is, I notice oil has dropped below $80 a barrel at the moment. Would you know why, and will that affect, is it because shortage of supply, oversupply, and will that affect the funds at all, please?
So oil price will have the biggest impact on your equity portfolio. So they're driven by economic output, and oil prices are a good indicator to depend on how much demand there is for oil tends to correlate with how much economic growth is going to be present. So manufacturing, particularly within China and emerging markets. Oil price does have a big impact on your UK allocation as well, just because of the UK's exposure to oil and gas. So if oil prices go up, often you'll find that the UK part of your portfolio will improve because a lot of the companies depend on oil price and will benefit from that increase, whereas you might find that other stocks within the global mandates might not perform so well because of the cost of fuel. So it tends to the price of oil is a good indicator of what the expectation of global growth is going to do. And global growth is looking positive over the next couple of years. So I wouldn't get too hung up on the price of oil impacting your fund too much, but it's a good indicator to suggest that things are going to be fairly buoyant for the next short term, at least next year or two.
I think the price of oil is one of the most heavily manipulated statistics on the face of this planet. But
Yeah,
Richard has another question.
Caution worrying too much about it. It's traded very readily. And
Richard and then Michael, I think.
Me again, Emma, sorry. The 5.5 million increase in the quarter, does that include contributions or is that excluding contributions?
It includes everything. So currently contributions aren't invested, they're used to meet benefit outgo. So it's not as if you're getting excess contributions and then they're going into the fund. They basically just cover what's leaving in pensioner benefits.
So our contributions are about £2 million a month, aren't they?
So you're at that sort of steady state level with what's coming in equals what's coming out. Joe will be able to comment better on exactly what's paid out on a month by month basis.
So this is portfolio growth. Yeah.
This is purely portfolio growth.
Yeah, absolutely. We've not made any new investments increasing cash going into our investment pool. We are swapping within our investment pool between investment categories, but we're not adding any new money into the investment. So the growth in the investments is pure market driven.
Michael.
I'm not sure whether this is a relevant question, but on the back of what Richard was asking, how much of the fund is actually going into renewable energy? Because actually that market is growing incredibly and actually making incredible profits. And it's going to grow even more with things. So how much of our fund is invested in renewable energy? Solar, wind and all that kind of stuff.
Yeah, it's quite a difficult thing to quantify just because there's lots of elements in the supply chain that feed into something like renewable energy. So you could have a company that manufacture parts for a turbine, for example, not just an energy supplier as that company, which all feed into those profits and benefits. The good thing about your growth allocation just now is the active element. So your fund manager's job is to identify opportunities in the market, which will include renewables. They will be all over that. And when you see Newton later today, that's a good question for you to ask them. What percentage of your portfolio is actually linked to renewables? And they will be able to answer that for you and also advise on how they identify what's the best opportunities within those markets. So it's up to your manager's jobs to identify where, like you say, all the profits are going to be in both the short, long and medium term. So whilst there's not, I don't have a percentage to hand as to what percentage is invested in renewables, it's a good question to ask Newton, who manage a big proportion of your global equities later. But every one of your mandates does have an allocation to renewables in some form or another.
Very quickly. I think that is a really good question, but as Emma said, it's very difficult to determine what is a renewable energy because, and I know this is not necessarily true, but there are stories of the big oil and gas companies investing a lot of money in research and development into renewable energy. So to an extent, it's where do you draw the line between it being a fossil fuel investing company and a renewables investing company? So it's very difficult to say. But what I would suggest, and as Emma said, Newtons are coming to this meeting and they invest about 30-something% of our fund in global equities, and they will be able to give you more information about how they consider renewables and oil and gas and other activities within their investment selection. So it's a really good question to ask the fund manager when they come in. Poker face.
Richard.
Jerk's reaction, so we put my hand up. More of a comment, and more for people in the room yourself. Page 155, Schroeder property. Joe knows what I'm going to say without me even having to say it. So I'll leave it at that. Thank you.
This is the social investment conversation. It's our property portfolio at the moment is not social investment, it is commercial property. There are opportunities for funds out there that do social investment. We have taken the view at the moment that we're not touching our property allocation because it's doing what it needs to as part of our portfolio strategy at the moment. Something that we can look into, and there are opportunities out there, is social investment, and whether that social investment is island, local, national, global is the question. And those are discussions that we need to have at some point. They are in my mind, Richard, you've made them very firmly attached in my mind, and Claire. So we will discuss them at future, but at the moment we need to consider it as part of a holistic review of our investment strategy, which we have the opportunity to do as part of the valuation that's coming up at the 31st of March 22. But again, it's not something that we could just pick up and say, we'll have that today. It would be part of a strategic decision, and then we'd have to identify the appropriate fund, where our beliefs sit, where the funds sit with our beliefs, and then identify the opportunities. And similar to the private markets that we're in at the moment with private debt and infrastructure, those investments may take time to develop as opportunities arise. So I'm not saying no, and I'm not saying yes. I'm saying it's something that we will be able to look at in the future, and I think Emma might have Do you have anything to add, Emma?
No, exactly that, Jo. So social housing is becoming a fairly well-established asset class, and many managers are starting to offer more funds available within social housing. And there are benefits to social housing, particularly the government backing and the kind of security of the rents that you receive. The only thing to caveat for that is that the investment business case needs to be robust, or the committee needs to be willing to have a financial trade-off for the risks associated with the local impact of an investment like that. If the investment business case is strong enough, then there isn't necessarily a reason that the funds can't invest in it, providing it is a better opportunity than anything else available to you. Because at the end of the day, your fiduciary duty as a committee is to safeguard the pensions of the pensioners that have paid into the fund. So you have to make the best investment decisions available for them and securitising their pensions. And so any investment opportunity needs to be the best one available. And if it is the best one available, one of the issues with social housing tends to be the scale of the project. So you usually try to limit an investment within a particular mandate to at least 5% of the portfolio to make the scale viable for the types of investments that we would invest in for a pension fund. And 5% of this portfolio is significant, and whether you can have a social housing investment that's going to be well diversified enough at that level is another thing to consider. But if there was those opportunities, there is freedom within your current property mandate to invest in different types of housing. So it's something you could also speak to Schroders about, in terms of your manager as a property manager is constantly seeking different investment opportunities, and social housing will be on their radar. So if the investment business case is strong enough, then Schroders themselves could also look to invest within that mandate, not necessarily the fund doing that directly. Currently, you as a pension fund do not make any direct investments. All your investments are made through managers, and so those managers have to deem those, you've delegated that decision to those managers, and they have to deem those opportunities as viable. And if they are, then the managers will be researching these in their own right. And social housing is something that Schroders will definitely be looking at.
I think there are three elements which are coming together within the council here. At the moment they're separate, but I know they're heading in the same direction. One of the initiatives is being led by Councillor Stevens on his housing portfolio, which has some significant opportunities around that. And we've already had some discussion and some figures from meetings that have come out from our finance officer on that. The second one is following the launch of Green Meadows. For those of you who are aware of it, at Cornwall, the wonderful Cornwall Bay in the West Wight, well known for its beauty and natural landscape. When we opened that recently, we took the opportunity to meet with one of the finance and investment directors who was there. They are very interested in following that up with other facilities. That was the second one on the island, perhaps a third and fourth, and perhaps much larger in scale. The majority of their investment, it turned out from our discussion, actually comes from pension funds. So that was the second wing of the three. The third wing, of course, is the determination, which you just heard, made by this committee in terms of how it directs its investments. So I have a feeling that all three of those are moving in the same sort of direction. Ultimately, the determination here is going to be, is that the best investment available? And we do have to be a little bit careful about how we judge that. So any other questions on section 9? No? Do we have a motion on that then at this stage? Simply note. Everybody happy to note? Good, but I think it's a very valuable part of the discussion, and it does help bring forward some of the other issues going on within the council at the moment. So thank you again. Thank you, Emma.
No problem.
Item 10 on the agenda. Here I get to hand over to Claire for the update on the working group. Starting at page 167 in your document pack.
Okay, yes, so we have been holding the ESG-RA working groups to look at setting our membership to start with, and so we have our group of people that are sitting on that, and we've had a couple of meetings now to discuss and draft terms of reference and decide how we were going forward with that group. And I think that's been quite successful because we have looked at many areas
and that there's a degree of complexity to all of those, and the decisions and the significant changes that are happening in the direction of investments, and that the opportunities that we need to investigate. So we are asking here to accept those terms of reference, and then we are looking at the membership of the LAPFF. I can't quite remember what that actually stands for.
Local authority.
Sorry.
Oh, is that in the next? It's Local Authority Pension Fund Forum. So I knew it was on a piece of paper there.
Yeah.
So that's what we are coming to the committee with, really, those decisions on those. Is that?
Thank you, Claire. I enjoyed the team's meeting with them, by the way, when they were talking about the role they do, and I was quite impressed by the number of local authorities that they currently engage and support at the moment, which is very positive. Any questions of Claire? Vanessa?
Yeah, I would like to raise a technical issue. It was agreed at our meeting unanimously that we should actually join the LAPFF, but when I thought about it afterwards, can that committee, which only consisted of 3 members of the actual pension committee, pass such a recommendation?
Sorry, as a point of order, what we're actually doing here is that the working group are making a recommendation to the Pension Fund Committee, and recommendation 23 in this report is that the fund's membership of the Local Authority Pension Fund Forum be approved. So the recommendation has come from the working group to full committee to make that decision, and it is the committee that makes that decision. And similarly, going forward, just to reassure committee members that aren't on this group, the working group will not be making any decisions as such. The working group will be making recommendations on beliefs, on activity, etc., to this committee, for this committee as a whole to make the decisions.
Thank you. Answers my question.
Good. Any other questions of Claire? Right, are we happy then to move forward and support the 3 recommendations, 21, 22 and 23 on page 169? Do I have somebody to move that? Richard, thank you. Somebody to second it? Thank you, Warren. Everybody in favour? Unanimous? Wonderful. Thank you very much indeed, and thank you, Claire. Right, moving on to item 11 on the agenda, which is the legal and regulatory update, which doesn't have a page. It's simply an update, a verbal update. Claire, Joe.
Claire.
Sorry.
No, it's not. No, it's not. It's me. That's what I'm doing.
Give it a go.
I'm not proposing to do a lot of verbally on this one because you've had a lot of information circulated, which is listed on the agenda, further down on the agenda. I would just like to draw members' attention to the fact that the new minister with responsibility for the local government pension scheme has been appointed, and that is Kemi Badenoch MP. She's an MP for Essex. So she's a member of the Access group, so we can nobble her that way, possibly. Lots of activity at the moment, as you can imagine, around climate change following the COP26 event. The Local Government Association are reporting that there will be consultation issued shortly from central government on climate risk and reporting, with new regulations laid from the 1st of April 22. So there's not a lot of time to consult and get those put through Parliament, but they will. That's around the Task Force for Climate Related Financial Disclosures, which I think is what TCFD stands for. So there's a lot of new regulations about disclosures in private sector pension scheme accounts, but also coming into public sector pensions from 2023-24, I think. There's lots of activities, just transition, Paris alignment consultation and various other activities coming out. So those will be circulated once the consultations are issued, and we will try to formulate a response that could be coming through from the Responsible Investment Working Group or generally through whoever wants to contribute to them. Thank you very much. It's unlikely that the new minister will get very far on the consultation, long expected consultations on pooling or the 95k exit cap revisitation, but there's a lot of work that's backlogged in the former MHCLG, which is now the DLU, some opticians chart letters. So that will come through as it happens. But again, it's a lot of activity that will come through the pension fund that we'll need to react to. So I will continue to circulate these matters as they arise, and we will list them on the agendas. But I don't think there's anything significant I need to add at the moment, unless anybody's got any questions.
Any questions then for Joe? No, I think thank you very much for that. I don't anticipate much of that is going to come to fruition very quickly.
No, but when it does come through, it will be required for action very quickly because central government have no concept of time.
Yeah, I do like the idea of nobbling the MP and pressing our case on that. I shall think more on that issue. Right, we're happy to note the report, everybody. Yes, lots of nods. Thank you very much. We'll note that, and we come on to the skills update, which is item 12 on the agenda, starting on page 179. And we should thank you for arranging all of the additional training and information, Joe. It's a lot to absorb here, but I think it's very critical that we are appraised of it and we have a continuous programme of learning on this. I don't think any of us here would declare ourselves to be pension experts. It is a very fast moving market, and we need to keep up with it.
Thank you. Just to reassure members, at the moment, and I say at the moment, there is no statutory requirement for pension fund committee members to have a minimum level of knowledge and understanding. There is a statutory requirement for members of the pension board to have a requirement of knowledge and understanding, which is quite counterintuitive to an extent, as the board is not a decision-making body, but the committee is. So you don't have to know anything to make your decisions, but you have to make the decisions. The board don't make any decisions, but they have to know it all. So there is a view from the governing bodies of the LGPS that there may become a requirement for minimum levels of skills and knowledge and understanding for committee members as well. But in the interim period, you are obviously the decision-making body, so therefore you do need to know what you're making decisions on and understand the requirements. So that's why there is an awful lot of activity happening in terms of knowledge and understanding at the moment. There is also a requirement that the knowledge and understanding of committee members and board members and officers is reported in the pension fund's annual report. Hence, it's important that you attend, that you record what you're doing, and you let me know so that I can record it. So what I've done is appendix 1 to this report. I've summarised the development sessions that have been laid on internally and your attendance at those. And I've also summarised, to my mind, the events that I've circulated to you that you can attend and what I think you've told me you've attended. If you could continue to keep me up to date if there are events that you're attending that I'm missing, or if there are events that we've held locally that you haven't been able to attend. All of those sessions have been recorded, so I can share them with you and you can review them at your leisure. It's a difficult area, and I fully appreciate that you are very, very busy people with your ward work, with your real life work, and with full council business. But you know, it is important. Thank you for volunteering to be on the committee, but you know, we do need to make sure that you do understand what you're doing and why you're doing it. So if there are any issues, any record of attendance that I haven't got, or if there are events that you're doing, please let me know. Please could I also beg of you that you complete the pension regulators toolkit the online training modules. I will recirculate the link given the look on Councillor Ward's face at that point. There are 7 modules which basically introduce the principles of governance for public service pension schemes, all of the areas of business that you need to know, governance, risk, complaints, contributions, and various other things I can't remember off the top of my head. There will be new modules coming out in terms of environmental and responsible investment, I'm certain, but that is a basic level of understanding that then can be built on with specific to the local government pension scheme, and then more built on for specific to the Isle of Wight Council pension scheme. So I will recirculate that link, and if I could ask you, if you've done them or as you're doing them, within that link there is a record of development, and you can track what courses you've done. And if you could send that to me before each pension fund committee, and I will ask you, so that we can then track how things are going, and we can identify areas that we might need more support with or more in-depth understanding. The one thing I would draw members' attention to, please, is that the next development date that we have booked, which is on the 12th of January. I'll let you have December off because, you know, December's busy. On the 12th of January, we've got a virtual session from our actuaries on the triennial valuation of the fund, which is forthcoming on the 31st of March 22. This is the chance when we look at our investment strategy, we look at our contribution strategies, and we look at the relationship between the individual employers and the pension fund. It's really important. It's one of the biggest decisions that the committee will make in its 4-year cycle. So it's really important that you can, if you can attend that training session, it would be really helpful. There will then be sessions on future committee meetings on progress, planning, progress, results and outcomes. But to get the understanding of what is going to happen, it's really important, particularly for new members of the committee that haven't been through this cycle before, to understand what is happening and what decisions will be made. So that's on the 12th of January. I will circulate the invitation, but please do attend if you can. It will be recorded.
May I ask, do we have the ability to traction free lunch?
It's virtual, so you can have whatever lunch you like.
Tomato soup.
I would just open really up to anybody that's been on any event that they might like to feed back on and ask any questions or raise any issues with. Excluding Richard. If he mentions social investment, I'm going to cry.
I think Ian wants to update you with his long list of things that he's going to do.
Joe,
Ian.
this is the first time I've been on the in all my years in council. I'm waiting for it to boot up. And to be honest, I mean, I can sit and watch a video, and I haven't got a clue what they're trying to say. Okay. They're talking jargon, I don't understand. So I think to myself, you know, am I qualified to make decisions? Because I really don't know what I'm deciding. I think I need more training than watching a few videos and what we've done. Okay. You know, I think you need a basic level of investment to sit at this, or training to tell you what it's about. I just feel disadvantaged that I don't understand what's going on.
Oh yeah, sorry. There we go. That's all I've got to say, really.
Should we suggest then that Joe, if you want to follow up directly with Councillor Ward afterwards and have a conversation about what exactly would help in this situation? I think we're all helping generally with the courses we're going on and looking at things online, and I think we'll all admit that we're not experts and we're learning very quickly. But if there's some additional assistance that Ian could be provided with, that would be lovely.
I mean, this is obviously very important. You know, we don't want to lose money and things like that, and we want to make sure our pensioners get what they due. And I feel a responsibility to them to make sure that we make the right decisions. And at the moment, I don't think I am.
Thank you, Ian. Trevor, did you have something?
I was just going to ask, are pension board members invited to that training on the 12th of January?
Yeah. Good.
Absolutely, I'll make sure that I recirculate all of the invitations. Just to just come back a little bit on with Councillor Ward, I'm very happy, Ian, to sit down with you for a little while and just point you in the right directions. I would reassure you, I think, that we are supported by some fantastic external advisors, Emma and her colleagues at Hyman's Robertson, who provide us with actuarial, investment and governance support. So we do rely a lot on them. They do circulate a lot of information. There is a lot of stuff going on. We do not ask you, as the council does not ask you as a pension fund committee member to make a decision without providing you with the necessary information to enable you to support that decision. And those decisions are presented to you based on recommendations from officers supported by external advice. So it is highly unlikely that you will ever make a decision that you do not have an understanding of. But if there are specific items that are coming up that are vitally important, like, for example, the triennial valuation, we will put on specific development sessions to support you through that process, and we will walk you through them as they happen. But absolutely, at any point, if there is anything that comes through that I send through, or you see that you have a question on, drop me an email. We can have a chat over a cup of coffee. We can have a Teams meeting, whatever, that I can support you through that as best I can.
Good. So are we happy to note that section 12, everybody? Thank you. Thank you, Joe. Item 13 then on the agenda, which we're just getting in quickly before Richard has to depart, which is the contract management section, which starts on page 183, Joe.
Again, thank you. This is just really an update of all of the contracts and advice and services that we procure for the pension fund to support us in the operation of that fund. We use the National Local Government Pension Scheme frameworks to procure most of our services. So that's a collaboration of local government pension schemes around the country, led by Norfolk County Council, where they do the heavy lifting on procurement. So they will identify suitable providers, they will vet those providers to ensure that they're suitable to deliver the framework, the services. They will negotiate terms and conditions, and they will negotiate ceiling prices. So effectively then opening up a framework to other local authority pension schemes to carry out their own local specification and run mini competitions without having to negotiate the technicalities of terms and conditions and detailed pricing. So it shortens the procurement process, but it also ensures that we've got the right tools available to enable us to select the right prices. All procurement is generally officer driven. Councillors may be asked to contribute if they have special expertise in the area, or if there is a relationship engagement that's beneficial. So equivalent to a beauty parade, where you would sit down and be presented, have presentations to identify the suitable party to deliver it. I don't propose to go through the report in great detail, other than to highlight that we have renewed a number of contracts. We've extended them for a year, so that we've got time to consider either a new framework being launched and determine whether we want those services to continue, or we've got time to consider a reprocurement where necessary. The timetable, which is summarised on page 189 as Appendix 1 to this report, lists all of the contracts, lists the framework, and the highlighted column shows what we are doing in the current year, what activity we need to undertake, and planning for those future activities. I'm not proposing at this point to go into any detail of those contracts in terms of terms and conditions and replacement, but as we come to renewal or extension decisions, we will need to move those discussions into the confidential session, because obviously they will contain commercially sensitive activity and discussions around suitability. So really at the moment for part 13A is noting the contracts that are there and the activity that's needed to maintain them and monitor them going forward.
Thank you, Joe. So clearly quite a big area of our work. And one thing I would like to do before we do it is just to remind everybody who's on the committee that if you have a conflict of interest with any of the organisations that we're undertaking contracts or contract renewals with, you should bring that forward. So are we happy to note that report, everyone? Yes. Thank you very much indeed. The next thing we have is the fund manager's presentation, which is... Sorry, 13B. Oh, 13B? Oh, sorry, I thought we'd...
Yes,
okay,
sorry, no,
carry on. 13B then, which is page 191.
Apologies. This is an annual compliance statement that's required to be submitted in terms of the Competition and Markets Authority's order for the Investment Consultancy and Financial Management Market Investigation Order 2019, effectively ensuring that we are carrying out appropriate procurements for the advice that we take, and that we set objectives for the investment consultants. I've set out in the paper the activities that we do undertake in compliance with this. There is an annual compliance statement that's required to be submitted 4 weeks after the cessation of the period. The period ends on the 9th of December, and so the report needs to be submitted by the 6th of January 2022. This is the committee before that deadline, and the next one is in February, which is after the deadline. So I wanted to draw this to members' attention and to note that this is the activity that we are going to undertake, and we will confirm compliance at the due date and ask Councillor Jarman, in his capacity as chairman, to sign the letter as it is due. Really to consider the objectives in the next couple of meetings of the committee. We will be looking at the investment consultants' objectives and reviewing to confirm that they are still appropriate. So the recommendations on page 193, that members note the objectives, confirm the compliance statements to date, and authorise the chairman to sign the compliance statement after the 9th of December, and report back to the committee in February.
Any questions of Joe on that? We need somebody formally to bring that forward to accept the recommendation 21 to 24 on page 198. Richard, and do we have a seconder? Claire, thank you. Everybody in favour? Given I'm being asked to do something, I should probably abstain on this one. Vanessa, are you okay with that? We just accept, there's a motion to accept the recommendations 21 to 24 on page 193. Yeah, thank you very much indeed. All right, so that's carried. Thank you. And when the time comes, I will duly pen to paper. Right, now we have the presentation, which is the next item from our external people. Richard's got to leave us at this point, and I'm conscious we've been going for an hour and 20 minutes. Should we just have a short 10-minute break while we sort them out and Richard departs? I'm sure people will need that comfort time. Right.
Thanks, Richard.
Right, we'll suspend everything. Oh, stretch the legs.
Somebody was delivering a high level of drugs or something rather. So then I know, so of course we are.
What's compliance with the
Thank you, Chairman. Absolute pleasure to be here today, I have to say, in person. We're getting out and about a bit more, and it's lovely to be able to come over to the island and see you all again, and some of you new faces as well. I'm David Moyes. I'm the Relationship Manager for the Access mandate, but also for the Isle of Wight, predating the transition of your assets onto the platform. And Paul is the Portfolio Manager, so he is the man who's sort of making the decision specifically on behalf of your portfolio. And we'll keep the session fairly interactive. What we wanted to do is to give you an update on what's been going on in markets, number one, and number two, how we see the outlook and how we're positioning the portfolio to take account of that. So we passed around the presentation. Page one, really, I'm not going to go through it page by page, but just sort of relatively quickly on page one. Newton have been delighted to have had a relationship with the Isle of Wight going back to 2009. So it goes back a long, long way. We manage a global equity mandate for yourselves. So it's trying to pick the best stocks from markets that, as we see it around the world. It's global equities really have been a fantastic place to have been, really. I mean, if you look at the specifics, back in 2009, you very kindly awarded us a mandate of about £82 million. As of yesterday, and that taking account of the fact that you took some money out recently, in the 5 million out in the last month or so, that value has gone from 82 million to 284 million. So it's been a fantastic investment, really. And even in the, this year has done really well for yourselves. Last couple of months done really well, and we'll give you an update on the performance in a moment. In terms of the team on page one, Paul is pulling the trigger, for want of a better description, on your portfolio. He is supported by Simon Nichols and Charlie French, each of whom have been with Newton for at least 20 years, and also by Jeff Munro. Jeff has been with Newton for 28 years and is going to step down. He's retiring at the end of this year. But obviously, from a continuation perspective, you've got three individuals who will be sort of responsible for the oversight of your portfolio, who have been with the firm for at least 20 years apiece as well. So, we're fairly comfortable with that, and we hope you would be as well. Other stuff going on in the background on page two. Newton is owned by an American bank, BNY Mellon. BNY Mellon, over the years, have acquired numerous investment boutiques, of which Newton is one of those. Earlier on this year, they decided that they would merge one of the US boutiques with Newton. So Mellon Investment Corporation has been integrated into Newton with effect from September of this year. What we're looking to show you on page two is, on the left-hand side, we show you all of the strategies that Newton have managed. In the middle, we show you the strategies that Mellon has managed. And basically, the key takeaway from this is that there was very little overlap in terms of the strategies that Mellon were managing. So importantly, from Paul, Simon and Charlie's perspective, what it does is it massively broadens the ideas that are fed through to Paul and the team. So they clearly have a wider universe to look at, because the Mellon people typically looked at small and mid-cap stocks. So it's sort of smaller than the type of stuff that we would typically have been looking at in the past. So it basically, what it does is it broadens the breadth of ideas that Paul would be seeing on a day-to-day basis. So we think it's going to be fairly positive. This happened in September of this year, but you shouldn't see any sort of significant difference in terms of what we're doing, the way that we think, the way that we manage the portfolio, etc. But I just wanted to get that out of the way from a housekeeping perspective. Moving on to the background, on page three, what we're looking at here is what we see as the longer term trends, the longer term things that are likely to sort of impact on economies, markets, and in fact our day-to-day lives. So the four things that we would highlight here are clearly the impact of climate change, and this is something that we've been thinking about and looking at going back over many years. It's not a sort of a COP26 change of mind. We think this is really, really important, and you've got to take these sort of factors into account in terms of the investment decisions that you're actually making. The second one is the increased dominance of governance, of governments, and really governments getting more involved in day-to-day lives. And you saw that at some level in relation to all the furloughing and COVID, etc. related stuff. But what you're also likely to see it on a more global basis, where there's sort of trade wars between the US and China and stuff like that. So governments, we think, are going to get a lot more involved in sort of economies from an international and from a local perspective. The third one is the slowing of globalization. So really the rise of nationalism and protectionism. So that's something that we need to be really plugged into. And the fourth one, which is important, is the authorities are becoming much more tolerant about inflation. Typically, if inflation had spiked in the way that we've seen in recent times, governments and central banks will be increasing interest rates, but there's clearly a limited appetite for interest rates going up at this particular point in time, and partly because there's a huge amount of debt built up in the system. So if interest rates went up, that would have a disproportionate impact. If interest rates go from 0.5% to 1%, that's a doubling. So, it's really difficult to do that. And at some level, I think it's also fair to say that a lot of the policies that governments have been following have been about pumping money into the system to try and get prices up, to try and inflate away some of the debt. So these are sort of longer term trends that we think are sort of hard coded into the system, and something that we need to be very mindful of. Now, I talked about the growth of your mandate and the fantastic performance of global equity markets in particular, and risk assets generally. On page 4, despite that, we still think it's right to be constructive about the likely returns that you're going to get going forward. We think equities are the place to be. They offer you liquidity. We think it's the right place to be. Why are we sort of constructive about it? If you look at the recent sort of trends, the vaccines that we've seen starting to be rolled out at the end of last year and the start of this year have been very effective. Obviously, most of us have been working from home, and this is just from a global perspective. So consumers are sitting on more cash than they typically would be. So there's clearly a lot of pent-up demand to try and go out and spend that. The companies are starting to restock, so you're seeing inventories being restocked as economies start to open up. So a lot of factories, etc., were closed down. They're now starting to build that up, and that obviously creates demand. Economies are picking up as a consequence of that. Governments are spending, and also companies are as well. Balance sheets are pretty good. And interestingly, the banking sector is in pretty good shape at the moment, unlike at the start of the credit crisis. If you look at the banking sector, the liquid assets that banks have on their balance sheet is at record levels. In other words, if something were to go wrong, they've got a huge amount of cash that they're actually sitting on. And also, if you look at the percentage of loans versus the assets that they've got, that is at record lows. So in other words, banks have really come through the credit crisis in pretty good shape. So we're fairly constructive about the environment going forward against that sort of background, despite the great performance that we've seen in recent times. In terms of what's been going on this year, page 5, really, I think, it has been a very, very good period for markets, but we think sort of things it's starting to get a bit more nuanced. So if you look at a lot of the support measures that have in place in terms of stuff like quantitative easing, etc., central banks are looking to start sort of scaling that back at this stage. When they've attempted to do that through the credit crisis, stock markets have had a significant wobble. But I think they've been a little bit better about signalling the fact that they're actually reducing the size of the punch bowl that has been printing money into markets. So there is talk of tapering, but we think that's not going to be sort of a major issue. There are clearly inflation pressures coming through. They're elevated. Inflation is at a sort of a 10-year high or more in the UK, and US is likewise. We think that is likely to sort of taper down over the next sort of 12 months or so. So inflation, we don't see it as being a sort of a significant long-term problem. So we're sort of comfortable with that as well. Fiscal stimulus has obviously been taken away. I suppose some of the factors that we will be a little bit concerned about is the Delta variant. As economies have started to open up, you're starting to see evidence of this coming out in Europe and the possibility of further lockdowns, but we don't see that as being a sort of, you might get a wobble if you like, but we don't see that as being a significant issue. And then the final thing we'd say is that the leadership of the markets has been driven by cyclical sectors with economies opening up. We think that that's probably a little bit overdone. So a lot of the cyclical sectors, as we will see on page 6, if you look, what we're looking at on page 6 is on the right-hand side, we're breaking down your global equity benchmark into the various industries underlying that. So if you look at the best performing sectors, energy, so that's obviously the oil sector, you'll probably be aware that in April last year, the oil price went negative for a couple of days, because what happened was there was an oversupply and there was nowhere to actually store it. The storage facilities were full. So anybody that had tankers coming into Europe or going into the US was actually paying people to take the oil off them. So it actually went negative 12 months ago. The oil price is now back at $80 a barrel. So clearly the energy sector has done really well. Financials have done very well, which typically would tend to do so when interest rates are predicted to go up. These are two sectors that we are underweight in. So they would be, if you like, would have been headwinds for us. So we're underweight energy, underweight financials, underweight real estate. So it's some of the sectors that have done well from a cyclical recovery perspective, we've been underweight in. On the left-hand side, what we're showing you here is the performance of each of the regional markets. So the best performing market was the United States market. Worst performing market was emerging markets, which is not sort of typical. If you're looking at sort of economies opening up, you'd expect EM to do fairly well, but there are very specific issues around that. But really what I'd say is, if you look at the sectoral performance, energy, financials, look at the difference between the top performing sector and the bottom performing sector. It's massive. I suppose this highlights, if you like, the benefit of active management, i.e. that we will pick stocks that we think will do well for you, and we think that's probably the way to go. Despite the headwinds, if we look at the performance on page 7, the headwinds being we're underweight in the sectors that have done very well. On the left-hand side, what we're showing you here is the performance of your fund going back over the last almost 10 years. And so the blue line is your portfolio. The orange line is your benchmark, and this takes into account the transition onto the Access platform a couple of years or so ago. So what you'll see at the end of October this year, we were a little bit ahead, and that gap has widened into November. But what I'm pleased to say is that if you look at the last almost 10 years, assuming we stay where we're at for the rest of this year, we will have outperformed in 8 of the last 10 calendar years for you. So number one, it's been right to have been in equities. And number two, I think we've done a pretty reasonable job for yourselves. The couple of years where we underperformed, 2016, particularly for the newer members of the committee, we underperformed in 2016. Most of that happened in the 4th quarter of the year when the Donald came into office and said he was going to make America great, and all of the cyclical sectors went through the roof. We didn't necessarily believe he was going to make America great, and we certainly were underweight in those sectors as well. So we lost a bit of ground in that particular year. But despite that, a 21% return would have been, I would have taken that at the start of the year, frankly. But, typically where we will lag a little bit is when you get sort of, sharp rebounds in sectors where we haven't typically been in. But as I say, from a consistency perspective, 8 out of 10 isn't probably a bad result. And as I say, looking at November, if you look year to date, if you look at the last 3 years, you're going through the credit crisis, your benchmark was up 21%, last 2012 up 12% despite COVID lockdowns. This year, year to date, to last Friday, your benchmark's up another 20%. So you're seeing phenomenal performance coming through. We're about 1.5% ahead of that this year. So despite being underweight in some of the sectors that have driven this, I think I'd be pleased to say that we sort of kept up. And I think interestingly, I was having a chat with Joe about a month or so ago. I know you're taking some money out over the next month or so. given that you gave us 82 million back in 2009, the amount that you're taking out is significantly more than that. So I think, you know, it's clearly been the right asset class to have been in that over that particular point in time. So hopefully that gives you a little bit of a flavour. As I say, performance has been pretty good. We're fairly constructive about the outlook. We do think there are going to be wobbles, particularly if you get sort of lockdowns and further lockdowns in relation to that. But I think we'd like to think that most folks would get the message and would get vaccinated in due course, which would sort of prevent these type of things taking place further down the road. So broadly speaking, fairly constructive about the outlook. And, you know, as I say, the numbers themselves have been pretty good. On that note, what I was going to do is to pass across to Paul, really, to drill down into the attribution a bit more, if that's what you want to do. But in the interest of time, I see you're on page 180 something of your papers. We're very happy to skip over that if it's not a level of detail that you want to go into.
Just ask me a couple of questions.
Of course, yeah.
I've known Mellon from the past, principally in the small and mid-cap sectors and mostly in the US, having lived there for a long time. How do you, I mean, that's clearly their weight, and I think probably most people would agree it's their background. How do you think that sector in particular is likely to perform going forwards, and how much of that benefit that might come in from Mellon do you think will come into the union?
I'll take that, Chris, if that's okay.
Yeah,
I think it's a very good question, because the small and mid-cap sector in any market tends to be the domestically focused stuff. Like the FTSE 250 in the UK is analogous in some ways to the SMID or the Russell market in the US. And so that will be largely dependent on dollar strength. It will be dependent upon the trajectory of US economic growth. And I want to be really clear that the mandate that you have with us in the fund for access does not change. The number of stocks which we can own is the same. The investment process from our point of view of selecting stocks, constructing a portfolio is the same. So the additional resource coming through and additional ideas coming through won't be going into the portfolio as a given. It really will be only anything that comes to us from the Mellon guys, which we think stacks up on valuation, which we think stacks up with our thematic views, and which stacks up with other considerations, for example, dollar strength, as we've mentioned. So the impact could be quite limited, but it could be quite extensive. It really does, in a sense, depend on how we're constructing the portfolio. One thing that is nice to have is more competition for capital within the portfolio. So if we do feel that there is a particular theme, for example, we're discussing at the moment adding a new stock in the heating and air conditioning part of the market, and there's a particular US company which the Mellon guys are very keen on, which is owned in their portfolios, which they would like us to be more involved with. And we will consider that. But I think the idea that all of a sudden your portfolio, I know you haven't suggested this, but I want to preempt the idea that the portfolio will suddenly be full of US mid-caps. It's not going to happen. It's really going to be just an additional string to our bow as regards what we can leverage as regards internal research capability.
You might choose to make some recommendation to us on that account. Particularly given the large fiscal stimulus in America that's just been announced. And
yes,
it seems to be a bit of a train that's gaining quite a lot of momentum over there in terms of the government activities.
There tends, that's right. And it would probably be the case that the fiscal approach of the current US administration, as well as some of its policies around healthcare in particular, might be less positive for the large cap space in the US. On a relative basis. So it could be that the mid caps, particularly if they benefit from, in some ways, an inflationary environment could be good for that part of the market as well. And that is likely to come around from the combination of fiscal and monetary policy, which we're seeing, which the Biden administration is more likely to, particularly on the fiscal side, likely to stoke up than Republicans would. So that could be quite positive as well. So I think I'm the team very open to ideas here, but I think generally, if any new SMID ideas make it into the portfolio, they're going to be on quite a stock specific basis. We're not going to be taking a kind of top down allocation view of bringing down the market capitalization of the portfolio. Does that make sense?
It does. So what is your opinion in terms of, you mentioned earlier that, with such a large fiscal stimulus coming out in America,
Yeah.
And likely what would seem to be perhaps a continuance of that policy going forwards, and given that that is likely to benefit the small and mid-cap market, maybe the mid-caps primarily, what would be your view on the likely performance of that general sector?
Oh, as a sector, yeah, okay. Well, to be honest with you, I wouldn't see. Look, it largely depends. If you have to frame that relative to other asset classes, and I think you'd have to frame it relative to the large cap space, which is dominated in the US now by tech, by growth style stocks. So if you see an environment where the stimulus is successful in reflating, but the market loses the fear that treasury yields will shoot up very significantly as a result of that, then you will see the large cap stocks presumably continuing to do quite well, particularly as the tech stocks tend to perform in a negatively correlated way to interest rates. So if treasury yields stay low, then the tech stocks should do well, and that drives the NASDAQ, drives the S&P. I think if you had an environment whereby the market took fright, the problem we have in the US now is that 25% of the market is in technology. If that sector underperforms, it tends to drag down the indices as a whole. And that starts, I'm not going to go into too much detail here because it could take all day, but it drives a whole set of technical considerations, which then leads to stop losses. It leads to index selling, shorting, and that drives the whole market down. And small caps would usually tend to get driven lower as a result of that. So the small and mid cap space would do better in an environment where markets in general were rising. I think if they were rising in an environment where there wasn't significant interest rate risk, I think they will probably, to answer your original question, I realise I'm answering your question, they do stand a good chance of outperforming, but we would want to be very specific about our exposure to that should we wish to take it.
And you mentioned some of the issues about the Asia Pacific market, being very mindful of that. One of the issues that seems to be a bit of a conundrum is that the large tech space globally, including America, the large cap market dominates many of those things, as you said, and they seem to be suffering by a lot of supply chain issues at the moment for issues coming out, chips and other issues out of Asia. So the lack of supply and the lack of ramp up coming out of Asia is driving down their performance, but that has a following effect into large tech elsewhere in the world.
It does, although the US government was already, before we saw this significant supply chain disruption become evident, we'd already seen the US government make plans to reallocate government resource to stimulating domestically produced parts. So, for example, you would have seen that the tail end of 2019, the CEO of Intel stated that they weren't going to be making any bits themselves anymore. They're going to go fabless, which means in technology language that you design your products and you outsource the manufacturing elsewhere. And that would benefit companies like TSMC, which we still own in the portfolio. That was reversed midway through 2020 when it became politically advantageous for the US government to bring manufacturing of chips back onshore, and they're subsidizing in states such as Arizona and New Mexico for new resources and facilities to be put in place to manufacture parts for semiconductors and parts for technology. So there will, if there is a geopolitical flare-up, particularly with Taiwan, be an impact on global technological availability. And clearly, if you're basing your assumptions on revenues continuing to accelerate in these areas, and there's not the availability of products to make those sales, that is an issue. I think that most governments, however, have been working very hard behind the scenes to make sure that there is a ramp up in availability, both through subsidies, tax breaks, etc. And I think that a lot of the economies in question may step back from the brink of doing anything geopolitically which would damage the semiconductor chain, because these actually do switch lays a golden egg from their point of view. That doesn't, of course, preclude the idea that the Chinese would allow the idea of disenfranchising Taiwan Semiconductor as a reason not to try to take control of the island. It's a big subject, but I think you're right that there is, especially given that valuations of the tech sector are still in some places quite elevated, that there could well be some sort of concern over there being ongoing supply chain issues. But at this stage, certainly from the stocks of the portfolio which we own, which are very large weighted, Microsoft, for example, is not really as impacted by those things as some of the more hardware related companies.
Any other questions at this midpoint from the committee? No. Warren.
So it's probably a very obtuse question, but given that you were talking about China and the like, what is, in terms of the portfolio position, what's the sort of general hedging strategy with regards to that geopolitical risk, given that it seems our exposure in terms of positions is fairly high?
Yes, it's not an obtuse question, it's a very good question. Look, China's been a difficult place for investors for a period of time now, and that's been, just to reiterate, due to the fact that the Chinese government has felt the need to reiterate its ethos, its basic philosophy, at a time when the Chinese Communist Party is celebrating its 100th anniversary. And that has resulted in various implicit and explicit actions. It does seem now that we're back to something much more dictatorship-like. It does seem that China is, to not to use too many words with too many syllables, fed up with pussyfooting around, and I think is wanting to start to flex its muscles, having been quite unwilling to be too controversial for a long time while it grew its economy. It now feels that it doesn't get the attention it deserves on the global stage. And the US had started to see this happening, and of course that was the start of the trade wars. What we've started to see more recently is quite an aggressive rolling back of a policy which was put in place to create wealth in China. And I don't know if you're aware of, I'm sure you're aware of this, but it doesn't hurt for me to reiterate. The philosophy of the Chinese government in the last decade or so has been to allow wealth to be created by a relatively small number of individuals, certainly a small number as a percentage of the population, on the understanding that the wealth that they created will be allowed to filter down to other parts of the population. And the creation of more billionaires in China than in any other country in the world has led the government to reassess, given they didn't feel that enough of that wealth was being sufficiently coming down to the main populace. An example of Jack Ma and his disappearance, etc., is a good example of that. So what that has then led to is a quite explicit policy of taking the companies created by those new billionaires and by making them do what is known as national service, which is to have them reduce their profitability, to fine them for not being too capitalistic in a sense, and also to be cracking down, quite ironically in some ways, on things such as human rights, which in some ways is laughable coming from the Chinese government. But for example, we had a stock in the portfolio called Meadows, which is the equivalent of Deliveroo in China, and they were treating their employees very badly, and the government used that as an excuse to fine them, etc. Now, we had exposure to a few names here. We had Alibaba, which is the equivalent of Amazon, really. Meituan, as we've mentioned, and we also had Ping An, which is a local insurance company. The weightings in all three have come down. In fact, Meituan we sold completely before it really tanked, I'm glad to say. The essential problem that we see, on the one hand, is that this stuff isn't going away. On the other hand, this is the biggest growth opportunity of any of our economic lifetimes, or as an investor, it's the biggest growth opportunity that I will see. And not to be involved with it in some way, I think, is remiss, particularly in a mandate like this, which has an all countries remit. But we don't think that valuations in China will be staying at the same high levels that they've been before. The market will trade on much lower PEs, much lower valuations, because investors won't be willing to give the benefit of the doubt over a multi-year or multi-decade period for future growth, given the risks to that growth. So Alibaba, for example, now trades on a PE of 15 times earnings, with growth of 23% in earnings. So a PE to growth ratio of 2/3, which is exceptionally cheap, really, for a stock of that growth. But it shows you how concerned the market is that the government will continue to be a problem. So do we just sort of say, okay, we're not going to have any China, or do we, hang in there? We are of the view that a couple of things are going to happen soon. Specifically on Alibaba, there's going to be an investor day where we think they will attempt to shore up investor confidence. Also importantly, the Winter Olympics are coming to China in a not too distant future. And the Chinese have a long track record of trying to impress the rest of the world when they host these kind of things. And we think that will be an opportunity to show the world the good things about China, and that may well be a bit more supportive of foreign investment. I know that's a long question, but it's a big subject. To answer your question, it's a big subject. So the short answer is we will keep some exposure, but I think we're going to be very circumspect, particularly around stocks on very high valuation multiples.
All right. Should we let you carry on with your presentation?
Yes, I realise I've not answered the question any less than, I've not used one word, well, 10 will do, right? Apologies for that. We've got the attribution for you. One thing I should add just to the performance comments which David made, I would really emphasise to you that at no period over that 8 out of 10 years where we've outperformed recently for you has the beta on the portfolio even been at 1. Now, what that means is that the volatility of the portfolio is lower than that of the market. But in a rising market environment, to outperform with a beta below 1 is quite good. Risk adjusted, they've been good numbers. So I just wanted to highlight that to you as well. The attribution here, I'm not going to go through this in too much detail unless you have specific questions. A couple of things I'd like to highlight. One is that you would have heard a lot about markets rotating into more inflationary cyclical areas. We did make some moves in that space to bring the portfolio into a much more balanced position at the end of last year. That's worked. And as you can see on the left-hand side there, a big mixture of what you may call more structural growth stocks, things like Alphabet, Applied Materials in the Microsoft and technology space, but also Goldman, which you will know about as you're a client of theirs, Albemarle, which is a lithium battery miner, so it provides the lithium for electric vehicle batteries, Ibara, which is a manufacturer of pumps for the water and oil and gas industries. So a real mixture of cyclicality and secular growth. On the right-hand side, those fears over China, you can see Alibaba and Ping An Insurance enormously damaging to performance, sadly. But obviously that's been offset, fortunately, elsewhere to some extent. AIA, which is a Hong Kong listed stock, but again, big exposure to the Chinese insurance market. So these have been really difficult for us. I would also highlight that not owning Tesla, you can see there has been the sort of 6th biggest impact on negative contributions in the portfolio. We've no interest in Tesla for 2 reasons. One is the corporate governance is very poor. You are getting, as a minority, pretty much undiluted Elon Musk, which I'm not sure neither you or I would necessarily want. But also valuation multiples exceptionally high. I would also would be Volkswagen in particular. We also think going forward, Toyota could be in a good space there as well. So that's really the offset to us to have Volkswagen in the portfolio. It's not Work versus Tesla, but a much cheaper stock. Any questions on any of that so far? No? Okay. Purchase and sales on the next slide. Again, it won't say too much. Just one I wanted to highlight was Universal Music Group. We still have a small holding in a French media conglomerate called Vivendi in the portfolio, but we only owned Vivendi really for UMG. And UMG is one of the big 3 players in music streaming in the world. It's music publishing, etc., but it has good exposure to the streaming market. And any of you that stream yourselves or have family members who stream will know that this has been a huge source of growth. I'm, an old so-and-so, and I still buy CDs, but not many people do that. Most kids now sort of, stream their music. UMG is very well positioned for that. We think that that's likely to be a very strong performer over the next several years. So we've kept the spin-off that we had in UMG shares in the portfolio. You'll also see that we've added a little bit in the financials, HDFC, which is an Indian bank. We think Indian banking is likely to benefit very much from the development of the middle classes in India, very well managed bank, great IT. And we also put in JP Morgan Chase, which we do see as being a very good executor in the US and global banking market, both retail banking and investment banking. A couple of things which we sold, Merck, where we felt that 2/3 of revenues coming from one product in a healthcare company is not healthy, even if it is a cancer drug, which Keytruda is. But we felt that that stock was unlikely to be a strong performer. And also there is a little bit of concern still from the new government in the US that once the COVID period is over, that the government will be tempted to do more on drug pricing, and that's not necessarily good for the pharmaceutical sector. And we also, as we mentioned, sold Meituan. Vitesco Technologies there was also sold to Zero, but that was a spin-off of the traditional internal combustion market from a company called Continental, which you may know from the tyres on your car. It's a German auto company. So we just sold that off. We didn't really think the underlying business was too attractive. Slide number 10 is the whole of the portfolio. I'm glad to say a couple of things that I would just highlight for your information. One of them is that an underweight of 10% to North America doesn't mean we don't like North America, but it is a function of the fact that the US and Canadian markets combined are now 62% of the MSCI All Countries World Index, which means that over half of the portfolio is still in North America, in fact, all in US equities. And we don't think that 62% of the best companies in the world are based in the US. So that's really an expression really of the best stocks that we have in the portfolio. Second thing is that we don't have a super positive view on Europe ex UK, but we have a lot of companies in the portfolio which happen to be listed in Europe. You know, companies such as L'Oreal, you know, Roche, you know, kind of companies which are global. Really, they probably have Europe as a, in some cases, single-digit percentage of revenues, but they are European companies from a technical point of view. So you shouldn't take that as being a particular expression in terms of geographical allocation. Any questions on any of that positioning? No? Okay. Well, that was really what I was going to mention. We do have another slide on 11, but I won't go through it in any detail at this stage. It's something for you to look at. But we tried to break down the portfolio based upon our thematic exposure for you, so it can just give you an idea of where the themes allocate in the portfolio rather than geographies or sectors. But that's probably something which you can look at your leisure, unless you have any questions about that right now.
And I was just going to wrap up on investing responsibly, because obviously ESG is sort of, every manager will tell you lots about what they do. From a practical perspective, just sort of a couple of headlines, I suppose, that I'd share with you. In terms of our analysts, we've research analysts that actually look at these sort of industries, etc. But we've got a separate team that every stock that Paul wants to buy, we've got a responsible investment team that do a separate report from an E, an S and a G perspective on every particular stock. So they have to produce a note outlining what they think of that particular company. They score it from an E, an S and a G perspective, and write a detailed report as to what the sort of opportunities and what the sort of possible threats are around that. They also will share the scores from lots of external providers, you know, ISS, MSCI, so we can see how our analysis actually compares and contrasts with what the market is actually saying. And what we'll do is we'll say, here's what our score is now, here's where we expect it to be 5 years from now. So in other words, we will engage with these companies, etc., and see where there's sort of room for improvement. So page sort of 12 shows you some stuff on that, but I suppose probably if I was to wrap up on page 13, what I'd show you here is we're showing you the BNY Mellon Global Equity Fund, which is effectively a proxy for your portfolio. So Paul manages it, but it's in the same sort of universe as lots of the peer group. Now this is just our sort of standard product. It's not sort of it's not really branded as some sort of environmental product or any sort of green product. But what I would highlight to you is if you look at the vertical line, you'll see that the ESG score is higher actually than a lot of the sort of, if you like, the environmentally branded products that are out there in the industry. And what I'd also highlight to you is that the carbon intensity, looking at the horizontal line, is significantly lower. So it has the standard product, if you like, the standard strategy that we're managing for yourselves has a better ESG score and a lower carbon intensity than a lot of the sort of sustainable blah products that are out there in the marketplace. So I think that isn't by design, that is the way that we actually think about investing. So long term, we think this is, you know, this is a portfolio that we are trying to beat the market with. We're not trying to be cleaner, greener, etc. But that's just the way that we think, and the analysis that we've done on the companies is bringing this through in you know, really strongly for you. So I think that's important. Separately, we've signed up to the Net Zero Asset Managers initiative earlier on this year. So effectively what we will be doing going forward is to sort of really set down targets as to where we want our portfolios to be sort of 3 years from now, 5 years from now, 10 years from now, 20 years from now. So we're working on that at this particular point in time. But I think our commitment, I suppose, to investing in a responsible manner shows through really strongly, I think, on page 13, which is that's just the way we think. There's no exclusions. Paul has total discretion as to what he wants to do with the portfolio. So I think we'd be pleased to say that we've delivered fairly good performance, fairly consistently, and have done it in a fairly responsible manner for yourselves. So hopefully that would give you some sort of comfort around us as an institution that's been sort of sensible people to work with. Because obviously we've been working with you for a long time and we want to carry on doing that.
Should we see if there are any questions? I think Michael had the first one.
I'll ask a quick question. But I was wondering, in particular. Oh, sorry.
I'll come on to my question. This is just a point, and it's just an Isle of Wight relevant point, where you actually mentioned BNY Mellon Global Equity Fund. Well, they are connected with AEW property investment portfolio, which is actually the problem we had for years with our Ride Arena owned under them. So I just wanted to point out that as an island, we weren't very happy with what they did in that regard, although it has been recently sold, the lease has been sold. So I just wanted to point out that sometimes we might be investing in things that are actually causing this island quite a lot of distress, which AEW did. And they are part of the Mellon Global Equity Fund. I'd just like to point that out.
Yeah, I mean, I think it's a fair point. Just to be clear, that that's our parent. You can't pick your parents, I suppose, at some level. But what I would highlight is that's their custody service. I think they're sort of global custodians, so they're one of the largest. So they look after the custody of those assets. So they don't actually own them per se. So my understanding is that isn't in your portfolio or anything. We've nothing to do with that. But I totally accept.
I'm just saying that there could be things that we invest in for our pension fund that actually do have an effect on the island, and we actually need to take that.
Thank you, Michael.
Take in consideration. My particular question, I suppose it relates to your point about oil and obviously climate change and side, and we obviously have a significant amount invested in oil at the moment. Obviously that's radically changing. But if you actually look at the global markets on renewables, they are actually growing and, actually good investment within that. So I wanted to know, in your policy in doing that relates in lots of ways of our policy, but also we have companies like Vectus that are actually building wind turbines and everything. So we have industry on the island which is sort of affected by this. But years ago, you could actually say whether that investment's right. But now, isn't it making sense to invest in renewable industries and electric cars and all the various things than compared to oil? Isn't that good business sense?
It is, Michael, and thanks for the question. A couple of things I would say. One of them is that we do have exposure through, for example, Samsung SDI, which makes batteries for electric vehicles. The EV space is something which we are very interested in. We only have one small legacy holding in traditional oil and gas in the portfolio, which is Royal Dutch Shell, which has been engaging very significantly with the market about its own renewables policy. A couple of things I'd say about Royal Dutch Shell: it's unequivocally one of the old-fashioned super majors. It'd be wrong of me to deny that. But there is still very significant energy demand forecast to come through for the next several years while the transition period occurs. The valuations are very low, the dividend yield is high. But also some of the valuations around renewables are very difficult to stomach. And we've certainly had some stocks in the market which have blown up as a result of becoming very fashionable. And we are a little bit concerned about that. But we are trying where we can to factor in concerns such as stranded assets, which are a big problem for the energy sector. You know, effectively, oil fields, for example, having zero value because they're not necessary anymore. I think there's something which is very much on our mind. And we are very much open to companies which have exposure to, you mentioned wind turbines. GE, which you'll see in the portfolio, is not the General Electric company that you remember. It's something very different. And a big part of his business is now making the world's largest wind turbines for power generation. So we are more exposed to those areas than is probably evident from the optics of the portfolio. Some of the more specific renewables plays can be very small. Some of them are in a structure, for example, as sort of investment trusts, which are quite hard for us to access. Yes, it's something which we are focused on. And in fact, the new research structure, which David described at the beginning, does give us more resource in that area as well, and something which we will be looking to increase in the portfolio.
Yeah, I mean, it's about the oil companies in your portfolio is about 1% at this particular point in time. We've been underweight relative to the benchmark weighting that we're trying to beat, really for the whole of the period since you originally invested with us in 2009. So it gives you an indication as to how we see the future for the sector, but it's a case of trying to have one or two in that we thought would be sort of the more sensible ones. But yeah, it's 1% of your portfolio. I wouldn't be getting too sort of het up over it. Thank you.
I was also looking at your utilities. It's something that we take a great deal of interest at the moment on the island for a whole variety of reasons, not least of all because of our current water company. And you have very little representation in the utilities sector.
Yeah. Yes, we have one name, which is Eversource, which is a traditional power generation stock in northeast of the US, which has been making some very significant changes towards moving away from fossil fuels towards hydro in particular. It's been a very good performer for the portfolio. It's done less well recently because as a highly regulated utility, it will tend to trade in line with treasuries. So at a time when interest rates are rising, that tends to be negative for those kind of business models with a high, regulatory asset-based models, as they're known, are allowed to earn a certain return. And also, of course, they're heavily regulated around inflationary pressures around pricing. So that's been less good, but we still think that going into 2022, that could be a good stock, but one where the percentage of generation coming from renewables is rising, particularly that hydro base. So that's all that we have. They've been it's been right to be underweight utilities at this time of rising inflationary concerns. They've been big underperformers, as you'll see from the performance slide a few slides ago.
Questions, people? Should we go around the room?
Yes, the one thing I don't see anywhere here, and not just you, is what we all have to do in the morning is get up and eat. And we keep talking about wind turbines, but, where are we investing in any form of what I call food production? And I don't mean food production across the ruddy world, which then creates an enormous carbon footprint. In Europe and especially in this country, we have the facilities, obviously, to grow the best beef in the world. And I'm not going to upset people by saying people should eat what they want to eat. But as I said, we have to eat, and we keep talking about technology and cars and wind turbines. And of course, the other big problem is water. I was always told the Third World War would be started over water. So where can we, for example, invest in an extra reservoir on the Isle of Wight? These are fundamental questions which sometimes you as fund managers can process, whereas we as little people don't have the input or the pull.
Well, I'm no larger a person than you, Vanessa, but I would say that firstly, we do have a bit of exposure to food production through Unilever and through Associated British Foods, although ABF, to be fair, is mainly made up of Primark. But they're food processors really rather than farmers or agricultural exposure, really. There are some significant ESG challenges that we've had to navigate around having some interest in agriculture. We've been interested in agriculture over the last year or so because it does tend to be quite a good place to be at the time of reflation. But we haven't found a way of playing that at valuations that we can stomach. For the reason, forgive the pun, for the reason being that there are concerns, particularly over meat production, over the efficiency of meat production relative to plant production, because that results in inefficient water allocation. It results clearly in question marks over animal treatment, but also through methane, which tends to come primarily from cattle, and that is actually very bad for the carbon, etc. So we've been scratching our heads a little bit about that. I agree that it's an issue. What I would say, however, is that the other side of the argument is that the world without certain types of unpalatable food production wouldn't be able to feed itself. So if you didn't have intensively farmed animals, if you didn't have some forms of genetic modification, and this is a fact rather than an opinion, I'm not defending any of this stuff, but actually if you were to take everything back to a much more environmentally friendly footing, it would be quite difficult to produce the volume of food necessary. The other big problem we have, of course, is overproduction of food in the developed world and underproduction of food in the developing world, which is something which is above our pay grade as fund managers to be able to influence, sadly. So again, I've performed the trick which I've done a couple of times in this meeting, which is to talk a lot and not answer your question. But what I would say is that we are very alive to the idea of trying to find ideas that can play into some of these themes. Some of our theme funds have exposure to plant-based foods. Those stocks are still quite young. They've tended to be very aggressively bought on high valuations, not very liquid in some cases, but there are things which we could consider for the portfolio. The other thing which we need to remember, if you want to get access to food at the moment, and Unilever is a good example of this, think about Marmite, think about Hellmann's, mayonnaise, any of the Unilever products. A lot of that stuff has long dates on it, and it sits in stock rooms, it sits in warehouses, and it's been paid for already by Tesco's or Sainsbury's, whatever it is. Which means that you're probably not seeing when you do your shopping that the prices of those things are rising very much, but the prices of meat and vegetables are going up. So there's going to be a delayed reaction, and the important thing there is, will Unilever be able to price for that when they have to start refilling those channels? And that is the key challenge. The other challenge that they have is that they have a lot of energy input into their food processing. So higher energy prices are also a negative for them as well. So it's not a straightforward sector to be involved in. Historically, they've tended to suffer from margin compression when you get an inflationary environment, but it's actually the supermarkets who do better when prices are rising, out of putting extra pricing through, than the suppliers do. Because Morrison's could say, well, okay, we've got 1 million jars of Hellmann's and we pay 50p a jar for it, but we're going to put it up from £2 to £2.25. There's nothing that Unilever that bring pressure on Morrison's, but there's not actually anything they can do about that. So Morrison's get that entire 25 pence of additional pricing. Now, of course, what happens then is the Unilever is likely to then put through a big pricing change in reaction to that for the next batch, and that's another phase. So we are aware of the challenges in food, but actually from an ESG point of view, it's quite a challenging space.
Right, Claire?
Come back to water. You know, why on earth are we building pipelines? We have a pipeline now from Hampshire under the Solent to provide water for the Isle of Wight. If you stood on the Isle of Wight on certain parts when it really rains and saw the water pouring over the cliff, I'm thinking, you know, why, how, would you agree?
Well,
You know, I mean, it comes down out of the sky and we do nothing with it. And instead, carbon footprint, pumping water across buildings, running.
Yeah, no, I agree.
It just is a no-brainer.
Well, look, a couple of things to that. One is that if there is heavy water fall in the way that you described, that's something which is likely to be at some stage embraced by some form of utility company or a power generation company. That I think is something where the trick is being missed. In terms of water supply and the ability of getting the capital in the right place to have that where you need it to be, I would suspect that's something which is probably going to end up in the hands of more of a private equity kind of environment rather than market equity environment.
Yeah, it's our infrastructure or actually sort of corporate bond issuance. So it's not in the equity sphere. The funding for that comes from other asset classes.
Yeah, I think you'll find some frustration here, particularly with these local issues. Water company is one of the big things on our list at the moment. I'm aware of the time, so we'll move on quite quickly. Thank you for that, if we can. Anything, Claire?
Yes, I have. Yeah, just related to all of those questions, really, is it moving fast enough with the climate change? Is everything in those sectors, are they reacting quick enough, really?
That's a $6 million question. I mean, what we've seen with COP26, for example, is that the determination to get something done was rewarded with something which has got, you could drive buses through some of the holes in it, right? And of course, two of the biggest superpower economies in the world weren't willing to sign up to things. The Chinese didn't even really turn up, not in an important way. The Indians were very keen to prevent stuff happening. And the world, of course, is in a space where they don't have much growth in the Western world, and they don't really want to annoy the guys that could be big business partners for them down the line. And that's going to cause ongoing problems. In terms of companies, we dig pretty deeply with management as regards what they're really doing, because greenwashing is a big problem, you know, and we've been very aware of companies who've been very keen to highlight things that aren't really material to how they're doing their business going forward. So I think the general awareness part is working well. I think now that there aren't many parts of society, either from a demographic perspective or from a social economic, maybe some parts of the social economic fabric don't really understand or don't want to understand, but I think most people are aware of it. And I think that will, as we're going now through a period where the demographics will shift significantly to a younger generation that's grown up almost entirely for their whole lives with awareness of this stuff, that will start to change things more quickly. So there'll be a natural shift towards more of these things being taken more seriously. I think it's going to, one thing that I would say to you as pension fund trustees, I personally have the belief that fiduciary guidelines and law will have to change. Because I think the idea that you're doing what you feel you need to do to allocate capital to where it needs to be to help that transition, where your nominal obligations don't fit with that, I think is wrong, and I think it's inappropriate, and I think it will change. And I think when that changes, I think you'll start to see more freedom to allocate where you think money needs to be spent than you do now.
Right, Matt or Ian, anything quickly, or we'll... Right. Yeah.
Thank you.
So David and Paul, thank you very much indeed for coming today. We very much appreciated that, and for your presentation as well. Very informative.
And thanks for your support. Thank you very much.
Yes. Thank you.
Just for members' information, I do have electronic copies of this presentation pack, so I will circulate them around as well after the meeting. So it's exactly the same as what you've got on paper, but so you can peruse at your leisure.
No. Thank you. Right, item 15 on the agenda, people. I think we just have to note this very long list of communications, do we, Joe? There's nothing else we need to do on it. No. So we'll note that one and go on to item 16 on the agenda, which is page 201, which is the work plan.
Thank you. Really, again, another item simply to note, you've got a lot of lists of items that we've already gone past, 2 pages of items that have already happened, to be honest, and then a couple of pages of forward-looking activity. Key dates are on there, and I've mentioned them previously. 12th of January, development session on Triennial Valuation. 26th of January, development session on our ESG RI positioning. There's a board meeting on the 2nd of February, committee meeting on the 16th of February. I circulated yesterday invitation to the Access virtual development session on virtual investment day. None of the investment managers that are presenting are relevant to us. We don't hold any investments in them at the moment. The Royal London bond portfolio is one that might be of interest to us at some point. There's lots of operational activities going on, and I'm going to change the format of this slightly to to incorporate it into a business plan, which I hope to present at the next meeting. Just really to note at the moment, unless you've got any questions.
No, and of course, the 6th of December for the Audit Committee has some repercussions on us as well. Thank you. We now come on to item, flicking the page, 17, which is members' question time. Oh, Ian's in very quickly.
I've heard mentioned a couple of times during this meeting that we've taken £5 million out of the pension fund. Why have we done that?
We've taken £5 million out of one of our investment funds to put into another of our investment funds.
That's fine. Okay.
I think things get moved quite regularly. Yeah. All right. Any other members' questions? No. Good. We now have to do item 18, which is to exclude the public and press. I don't think we have any actually, do we? Right, we'll consider them excluded, but I presume we do need to terminate the link.
Thank you, Emma.
Thank you. Bye. Bye.
If you could just confirm, Megan, when the link is terminated.